So, when we look ahead to 2026, the market is sending some seriously mixed signals. We're not talking about a clear path forward here. Instead, we're facing a landscape of deep divisions and conflicting forces, a great divide that could really define the entire year. Let's break down what that means.
And this quote from JP Morgan's research really just nails it. The key phrase here is multi-dimensional polarization. It's not one single issue. It's like there are several fault lines running through the global economy all at once. You've got this huge chasm between AI stocks and, well, everything else. You have businesses spending a ton of money, but the job market looks kind of weak. And you see this growing gap between what high-income and low-income folks are spending. It's a really complex picture, and we're going to unpack it piece by piece.
If you want a little preview of what this polarization feels like, you just have to look back at the crypto market in 2025. Man, what a year of whiplash. We saw major coins like Bitcoin and Ethereum just rocket to all-time highs, right? A huge wave of institutional money finally came in. But then, almost as fast, things turned and they plummeted. Some of the smaller altcoins lost over half their value. This is exactly the kind of divided, extreme sentiment that's setting the stage for 2026.
So how in the world do we make sense of all this? Well, we're going to break it down into 5 key parts. First, we'll go a little deeper into this whole polarized outlook. Then we'll get into what's next for the AI supercycle. After that, we'll look at the big battlegrounds, stocks, crypto, and real estate. Then we'll cover the major wildcards to watch out for. And finally, we'll talk about how to actually navigate this new landscape.
All right, let's kick things off with artificial intelligence, because it's the engine of growth, but it's also the source of the market's biggest debate.
And wow, this visual, it just says it all, doesn't it? You can literally see AI here holding up a world that's being weighed down by tariffs, by inflation, by debt. There's no question AI is driving record investment and earnings, but it also brings up the single biggest question. Is this a sustainable boom, or is it just a massive speculative bubble?
And yeah, that right there is the million-dollar question on every single investor's mind. Can this incredible momentum keep going? Or is the market just getting way, way ahead of itself?
Okay, take a look at this chart because it really gets to the heart of the issue. This is showing the estimated earnings growth for 2026. The Magnificent Seven, the biggest tech giants, they're projected to grow their earnings by a staggering 20%. And the other 493 companies in the S&P 500, just 11%. This isn't a broad rally, it's an incredibly narrow one, which creates a huge concentration risk where the entire market is basically hanging on the performance of just a few stocks.
So up until now, the whole AI story has been about one thing. Phase 1, the race for computational power. The entire narrative was dominated by the hardware, who can make the fastest, most powerful chips to train and run these massive AI models.
But here's where the story takes a turn for 2026. Analysts are now pointing to a new AI power crunch. The focus is shifting from computational power to electrical power. Think about it. All those data centers are absolute energy hogs. So the smart money is now starting to flow towards the utilities and the infrastructure companies that are going to be needed to keep all those AI servers running. Okay, let's switch gears and look at where these battles are really being fought. In the big asset classes of equities, crypto, and real estate. This is where the bulls and the bears are clashing head-on.
So in the stock market, you've got these two totally opposite camps. The bulls, they're looking at the research and saying, hey, earnings growth for the rest of the market is finally picking up. This rally could get much broader. But then you have the bears, and they're saying, not so fast. That record concentration we just saw, it's not going anywhere. And that creates this fragile winner-takes-all market that's really vulnerable if one of those big guys stumbles.
Now let's talk crypto. The bull case here is powerful, and it's pretty simple. Institutional adoption. Bitcoin ETFs bought 22 times $1 billion worth of Bitcoin in 2025 alone. Just let that sink in for a second. And the thing is, the real heavy hitters are just getting started with offering access in 2026. That demand could absolutely go parabolic. But right on cue, just when you think it's all clear skies, the bears step in. You've got technical analysts looking at the charts, specifically something called the Elliott wave theory. And their take is that Bitcoin might have already completed a full rally cycle, which could mean a much longer, deeper correction is coming. It's a classic clash between the fundamentals of adoption and the technicals on the chart.
And this polarization isn't just between different asset classes, it's happening within them too. Just look at US real estate. There's no single story here. Data centers, booming, no surprise there. But the office market is a tale of two cities. Brand new prime space is hard to find, while older buildings are really struggling.
Multifamily housing has strong demand, but then you've got this oversupply problem in the Sun Belt. It's a market of individual stories, not one big trend.
All right, as if all that wasn't enough to think about, we've got to talk about the wild cards. These are the big external forces, the economic and geopolitical risks that could just throw a wrench into any forecast.
And here's a crucial one. While the base case for most analysts is for continued growth, you absolutely cannot ignore this. JP Morgan's research puts the probability of a U.S. recession in 2026 at 35%. Now, that's not a prediction, but it is a very significant risk that investors have to keep in the back of their minds.
One of the biggest headaches creating this risk is sticky inflation. Even after all the supply chain problems faded, inflation has just stubbornly hung around that 3% mark. And this puts central banks in a really tough spot. If they cut interest rates to help a weak job market, they risk inflation flaring back up. But if they keep rates high to fight inflation, they could push the economy into a recession. They're really stuck between a rock and a hard place.
And then, of course, there's the whole geopolitical stage. We're seeing NATO nations dramatically ramping up defense spending in response to Russia. Trade tensions are still a major concern for global supply chains, and the potential for military clashes, whether in Eastern Europe or the Indo-Pacific, just adds another profound layer of uncertainty to everything.
Okay, so we've painted a pretty complex, pretty divided picture. The big question is, what do you do about it? Let's talk about a framework for actually navigating this new landscape.
This is it. This is the key question that all this analysis leads to. In a world that's sending so many conflicting signals, a world with such deep divisions, what's the right approach?
Well, when you boil down all the research, 3 key principles really stand out for 2026. First, after years where concentrated bets were the big winners, diversification is roaring back into style. Second, it's about focusing on long-term structural themes, like that AI power crunch we talked about, instead of chasing short-term cyclical trends. And third, active management is absolutely critical.
And that last point is so important. In a fragmented world where performance can vary so much between countries, between industries, and even between 2 companies in the same sector, just buying a broad market index, a passive strategy, might not cut it anymore. Selectivity, making careful, active choices, is more important than ever.
And that leaves us with the ultimate question for 2026. We know AI is the market's most powerful engine right now, but is its incredible force going to be a rising tide that lifts all boats, pulling the whole global economy forward together? Or will it just accelerate the trends we're already seeing, creating even bigger winners and losers, and ultimately deepening the Great Divide?